Stocks sinking here. We had a pop and then sort of lost some steam here after the Federal Reserve decided to keep interest rates unchanged in June and signaling more progress is needed before officials will consider a cut. The central bank's decision comes amidst a busy week of earnings. Tech giant Apple, of course, is next on deck, set to report results after the close tomorrow. With more, we're joined now by Mona Mahajan, Senior Investment Strategist at Edward Jones. Mona, it's always good to see you. So, maybe we'll start there, Mona. Just big picture. Give us your take on what the Fed said and did today.
Yeah, overall, it was a less hawkish message than a lot of investors expected heading into this press conference. In fact, Jerome Powell clearly stated he doesn't think the next move is a rate hike, and that was a concern heading into this call. He also noted that his personal view is that inflation will moderate as we head towards the back half of the year. So when he was asked directly, do you think this recent string of inflation coming in hotter than expected is just bumpiness? He said, yes, essentially, he does think that. And so we do think there were some less hawkish, perhaps a little bit more dovish messages coming out of the Fed chair, and markets certainly reacted to that. But we started and ended around the same levels in the markets, perhaps because we're kind of at the same point where we started this conference as well. Rate cuts are probably the next move, but we don't know when they're coming. Probably, in our view, sometime later this year, but we will still need to see a string of better than expected inflation prints before we get there.
I mean, with that said, the Fed chair all but took that hike off the table today and saying that's not likely to be the next move. Is it still about the Fed going forward, or is it about earnings, as Miles was saying earlier?
Yeah, it's a great point, because we do see kind of two narratives in this marketplace. One was around the Fed and inflation coming in hotter than expected, this higher for longer narrative. But the second narrative, to your point, is what's happening with economic growth and specifically earnings. And in some ways, that narrative may be more important, especially for markets and stocks. We know stocks are underpinned by earnings growth. Now, what we're seeing in first quarter earnings thus far it's been a mixed bag, but overall, earnings are coming in better than expectations. We're a little over 50% of the way through earnings season, and we're at about a 78% earnings beat rate. So right in line with kind of 10-year historical averages. And by the way, that beat rate is about 8% higher on average. And so we are looking for earnings, not only in Q1, but for the full year to come in at about 10%, much better than last year's kind of 0 to 1% earnings growth rate. So earnings and growth continue to hold up. We'll get a jobs report this Friday that give us a picture on the labor market. But broadly speaking, we know the U.S. economy is held in there. The consumer is held in there. The question, of course, is can that continue in this higher for longer environment?
And Mona, as you kind of made your way through this earnings season, you're combing through these reports, you're listening to conference calls. Did it cause you to kind of adjust or rethink, Mona, where you want to be invested in the stock market?
Yeah, it's a great point, because certainly what we've seen, for example, in mega cap technology, there was a lot of expectation going into this earnings season. Not only were the stocks bid up, but we had three of the sectors, comm services, technology, and consumer discretionary, were supposed to drive most of the performance. And for the most part, mega cap technology has delivered. In fact, when you think about these companies with large balance sheets and sizable cash positions, they're a little bit more immune in this higher rate environment, in that they don't need to tap the debt markets to reinvest in their businesses. And by the way, they're benefiting from these higher yields. They're getting on their cash, and they can deliver some of that value back to shareholders. We saw that with initiation of dividends, in some cases ongoing buybacks. So generally speaking, as we're headed through this investment earnings period, we're continuing to see some of that momentum in large cap technology continue. But we would expect, as we look forward over the next 12 months or so, parts of the market that have lagged to start to play some catch up. So we still like areas of cyclical sectors and areas like mid-cap stocks that really can, from a valuation perspective, have more scope for valuation expansion. And as we head towards the back half of the year, if we get better inflation trends, the Fed is closer to cutting rates, and earnings is more balanced in the last couple of quarters of the year, we think that's a catalyst that unlocks value beyond mega cap technology.
So is now the time to diversify that portfolio, Mona? I mean, the expectation that maybe the hike or the cut is not coming in the immediate term, but later this year, potentially early next year. How do you assess that portfolio in line?
Yeah, we think Yeah, we think it's actually, we should use periods of volatility as an opportunity to diversify, exactly to your point. If last year, 2023, was this year of the Magnificent Seven on one hand and cash and CDs on the other hand, we think 2024 will eventually be the year of diversification and balanced portfolios. So in equities, we'd say make sure you have exposure not only to that AI trade, because that is a long-term secular theme, but kind of fully valued here, but also to other parts of the market, what we call the S&P 493. But on your bond portfolio, make sure you're not too overweight those cash-like instruments, because as we think about the next 12, 18 months, as those CDs come due, there is some reinvestment risk, one, but there's also an opportunity cost. If we think about investment grade bonds here, that duration starts to look a little bit more attractive as yields are heading back towards what we think are probably peak for this cycle overall. And not only are you getting those better yields, locking them in for longer, but you have the chance for price appreciation if and when the Fed pivots lower. So we want to make sure in both our equities and bond portfolios, we're making sure we're diversified across the board.
Mona, great having you on the show as always. Thanks for joining us.
Thank you, guys.